Hey, this is Sasha. Thanks for joining me in today's video. And what I have for you today is we're going to go over kind of the number one thing that most option sellers do not know about or just don't think about as they're doing kind of their trade. So as we go in and talk about these things, I want to give you some insight. So this is kind of like a little tip video and some insight. So it shouldn't be too long, but I'll give you some things to think about if you're selling options like credit spreads, put spreads, and those kinds of things. So let's kick things off first. I'm going to go in and share with you some things on paper here first. One of the things that most people do when they go in and they look at selling, let's say, put spreads. So let's just talk about selling puts for credit, right? So now you've got a put spread here for sale, and they go in and they try to collect some premium. So sell point is right here. So here's our price. And now they kind of go in and try to sell the puts. But the problem with this is that when they go back, what many people do is they put in a stop, like say, hey, this is the stop that you put in to get out. And this is like your out point. And they kind of determine it based on the amount they're willing to lose. But the issue with this and thinking about it this way is really when you're looking at it like that is it goes against you many times and the probabilities start to work against you if you're setting a stop that's much more so than giving it room to work. So what I mean by that is that people doing this don't understand the probability of touching. Okay, so when you start looking at probability of touching, and by touching meaning that, hey, the price can actually go to certain points of that short strike that you create. And as we do an example here and go to the screen, by the way, if you want to check out our website, it's a good spot to kind of put it in. Just check out tradersfly.com. There's a lot of great freebies, courses, material, and a lot of other fun stuff. Anyway, if we go into the trade tab here, and let's say I'm doing a sell spread on Meta here, so this Facebook thing, and I go about 37 days out, and now I'm selling a put spread over here. Okay, so what happens is that we might sell it based on the delta here. Okay, but what's interesting is the deltas gives you kind of a probability, and I'm going to give you a little change here. So let's do a layout. I'm going to go like this, give you a few more factors here. So I'm going to switch these out. We'll go switch this to a delta, probability of out of the money, and then probability of touching. Okay, so here's the thing. If we go in and the current price of Meta is 141, okay, which is right here in this purple. If we go 141, okay, our delta is right there around that 50 delta. Now, I might say I want to sell a put spread way further out of the money at about a 20 delta. Okay, let's say about 125 is the strike. So that gives me a 0.21 delta. And probability out of the money seems like, oh, it's a 72%. 72%, that's a pretty good odds, right? Probability of out of the money is 72%. So if you go in and kind of look at the columns here, let's kind of reduce this a bit and we'll go to, let's say, what, 50 strikes maybe? Maybe 40 strikes. Let's see here if we can do it. Now we can see kind of the columns a little bit better. Okay, so if I go in, I got a 72% chance. That sounds like a good deal, right? But here's the issue with this is the probability of actually touching that strike is 50%. So you got a coin flip of saying, hey, it actually might come back into this area and I might get stopped out. So in order for you to kind of do these spreads, you have to allow them to oftentimes go in the money because they can then whip back up and be just fine. So it's important to understand what probability of touching really involves is that what people do is they end up going here. They see it has a high degree of working out, but they don't recognize that, hey, when it pulls back, I got to give it a good chance to even get in the money sometimes for this to work out. So setting up this spread, let's just go to a 125 and let's go to a 122. We'll sell this one. We'll buy this one. And then we'll analyze the trade. We'll go to 10 contracts here. Okay, so now I've got like a little bit of a spread thing going on. All right, so here's the thing. You got this trade on that's risking 2,350. You want it to go up, but as it goes and wiggles, it might actually start pulling back. And you set a stop that, hey, oh man, you know, I'm trying to make $600, but now I'm down 395. Now you're saying, okay, I got to stop and get out. Well, what you just did was you got out at the 130, call it 131. Okay, you got out at the 131, and the probability of this actually touching the 131 is a good 68%. So when you start looking at it that way, you have almost a 70% chance of it actually coming back over here, because those probabilities are based on just of it expiring, right? When you're looking at this initial probability of out of the money, that's at expiration. But here, as it goes back slightly, and now you get stopped out and you get the fear of it instilled in you, and you're like, oh, I'm out. And then it just shoots right back out. So if you've ever had this experience, it's probably because you're trading a little too large for what you're comfortable with, and you're not giving enough room for it to come back and wiggle. So trade a little lighter as a tip and insight, but ultimately you have to take the probability of touching or it to come in and test your short strike a chance. Otherwise, the probabilities just don't work out very well. Anyway, I hope that helps, gives you a little insight. Definitely check out the Traders Fly site. You could book a free 20-minute call if you like and discuss some things. We've got the options course that just launched not too long ago, the verticals course, talking about these vertical spreads right there, weeklies if you like to trade weeklies. So tons of good stuff. A lot of the stuff that I do is actually working with people one-on-one, because I find not a lot of people do that, and many people out there actually need to work one-on-one, and they prefer that. So you can book a free 20-minute session to discuss your personal needs, where you're at, and see if it's the right fit. But anyways, check that out. Truly appreciate you joining me today. Hope that helps. And, use this tip to maybe your benefit to start thinking about more probability of touching, not just probability of it expiring or using the deltas as probabilities. You have to take into account the probability of it actually touching that short strike. So thanks for joining me. Enjoy the day ahead, and I'll see you next time.